Imagine you wake up on a Monday morning, check your banking app, and notice your savings balance hasn't moved much since last week. Meanwhile, you hear about a friend whose account seems to grow faster, or maybe someone in the news keeps talking about how the rich keep getting richer. You wonder, is there some secret math behind all this? And if there is, why does it never seem to work for me? These kinds of questions linger quietly when we review our finances, especially when we see others getting ahead seemingly with little effort. It feels familiar, doesn't it? That subtle frustration, the comparison, that nagging sense that the rules simply don't add up in your favor. My name is Matthew, and I spend way too much time thinking about how banks use hidden mathematics to decide who gets richer. This conversation is for those caught in the middle, not quite struggling to make ends meet, but not fully comfortable either, who sense something unseen shaping their financial reality. If you find yourself puzzled by why wealth feels so rigidly distributed, even though you work hard and save regularly, this video is for you. Stick around. If this topic connects, maybe there's someone in your life who'd quietly benefit from hearing this too. Let's delve into this with both patience and care. We often hear a common belief around money. If I just save enough and keep careful track, I'll eventually get ahead. It's an idea many intelligent people hold. Saving money is responsible. Budgets keep us disciplined. Avoiding debt seems wise. On the surface, this makes perfect sense. After all, if you spend less than you earn, you should build a financial cushion. Emotionally, this belief feels comforting. It offers control and a sense of accomplishment. It reassures us that the future is something we can shape through effort and sacrifice. There's a certain quiet pride in saying no to immediate pleasures for delayed rewards. It also helps us avoid the anxiety of financial chaos. So logically and emotionally, it feels right. But here's the twist. While saving diligently is important, saving alone misses a crucial part of the picture. To unlock who really gets richer, we must understand what happens inside the bank's hidden math, where variables like credit decisions, risk models, and interest mechanics create an invisible playing field tilted toward some players. For example, say you save $200 a month for 10 years. That's $24,000 without any interest. Now, if you put that money under your mattress, it stays exactly the same. But put in a bank account earning a modest 2% interest compounded annually after 10 years, you'd have about $27,000. The bank makes a little money on your deposit, and you gain a small amount just by saving. Meanwhile, someone else with the same $200 might apply for a loan to buy a car, invest in education, or start a small business. Banks use sophisticated scoring models to decide who to lend to. The borrower ends up with more capital up front, but pays interest on that loan. Now, here's where it gets interesting. Banks earn money both from savers and borrowers, but their system rewards those who borrow and invest, adjusting terms based on credit score and collateral. Imagine the bank views lending not purely as risk, but as opportunity. If you have a robust credit score, steady income, and assets, you're likely to qualify for loans at lower interest rates. That access to credit means the bank trusts your potential to grow wealth, anticipating you'll generate enough income to repay the loan with interest and perhaps invest the surplus profit, accelerating your financial growth. Let me give you a second example from a different angle: inflation and fees. Suppose inflation runs at 3% yearly. Your saving account interest at 2% fails to keep up with inflation, effectively making your real savings decrease in value over time. Every year, the money you saved buys a little less than the previous year. Meanwhile, if you can borrow at 3% but invest at a higher return, say 6 or 7% through stocks or business ventures, you harness inflation to your advantage, leveraging other people's money to grow your net worth. Banks are well aware of these dynamics. They engineer financial products and credit scoring to channel money toward those with the financial profile that promises a higher return. The hidden math is the complex risk and reward algorithm baked into lending criteria and interest setting, favoring borrowers who demonstrate growth potential rather than mere savings. To make this clearer, picture Sarah. Sarah is a single mom with a stable job. She consistently saves $200 monthly, builds emergency funds, but cautiously avoids loans fearing debt traps. Meanwhile, her neighbor Mike, who shares a similar salary, takes out a small business loan to open a side venture. Sarah's savings grow slowly, trapped by low interest and inflation, while Mike, despite some risk, taps into bank credit, expands his income opportunities, and increases his net worth faster. You might object, but debt is dangerous. Banks just want to trap people with high interest, and that is a reasonable concern. However, the issue is not debt itself. It is debt without strategic purpose and the uneven access to good borrowing terms. When you borrow under favorable conditions and use the money to create value, debt becomes an engine of growth, not a trap. Zooming out, we see this is less about individual success or failure and more about systemic patterns. The banking model rewards what it calls creditworthy risk. This creates a feedback loop. Those who receive affordable credit opportunities can build wealth, which in turn improves their credit profile, and they get access to more and better credit. Those excluded remain stuck, with their savings eroding in real value, perpetuating inequality. This is not a failing of the individual, but of a system designed to optimize bank earnings and secure growth through selective credit allocation. Understanding this system's math frees us from simple blame and opens possibilities to navigate it smarter. Have you ever wondered what it feels like to be in the bank's shoes, making decisions on who to help grow richer? Imagine the bank as a gardener tending a large garden. It waters certain plants more generously because they show promise to flourish and bear fruit that can be harvested repeatedly. The plants that seem only to absorb water but yield no fruit get less attention. But what if the garden's layout and soil favor certain plants from the start? That's the hidden math behind the scenes. Or think of the banking system like traffic flow on a highway during rush hour. The bank controls the lanes and timing of traffic signals. It prioritizes fast lanes for vehicles with certain stickers, the creditworthy borrowers. Those in the slow lanes face stop-and-go traffic, making their journey longer and more frustrating. The invisible rules of who gets priority change the path and speed of financial growth. With these analogies in mind, consider how might you reposition yourself to become one of those plants that receive nurturing or a car that gets green lights consistently? Is it just about spending less and saving more, or about understanding how credit and time work together to propel wealth? Reflecting on this, we might ask ourselves, what are the habits or beliefs that hold us back from accessing financial growth tools? How does fear of debt or distrust of banks shape our choices? What small step could shift your relationship with money from a rigid, exhausting trove of saved pennies to a dynamic engine that compounds value over time? Instead of thinking, I am not good with money, try reframing. I am learning the language of money and its hidden mathematics so I can invite it to work for me, not against me. As we consider this, think about this with kindness toward yourself. Financial systems are complex and often opaque. It takes time and patience to decode these invisible forces. But once you see the patterns clearly, you can begin to move deliberately within them. To recap, banks don't just see your current savings. They calculate your potential, your risk, and your ability to generate future income. Their hidden math rewards those who access credit as a tool for growth. Meanwhile, purely saving money without engaging these systems risks stagnation. The difference is subtle but powerful. The deeper truth here is that wealth accumulation is rarely a solo journey. It is shaped by relationships with institutions, patterns of credit access, and time itself. By exploring both the numbers and the psychology behind this, we open a path that feels less daunting and more intentional. Before we finish, I want to share a simple yet transformative habit that can help manage spending and create a cushion to eventually engage more confidently with credit and investment. I call it the 30-day rule. Whenever you feel an impulse to spend money on something non-essential, wait 30 days before purchasing. This pause lets you detach from the immediate craving, reduces impulsive emotional spending, and often reveals whether the purchase is truly valuable or just a fleeting desire. No need for willpower battles or guilt. It's a gentle way to rethink how you spend. Over time, This practice helps protect your savings and builds the mental space to learn and plan bigger financial moves. If you found this perspective helpful, it might quietly help someone you know. Even if you feel you understand these ideas already, sharing this could light the way for another person still wrestling with the hidden math that banks use to decide who gets richer. There is a whole other layer to explore about financial systems, how credit scores themselves are engineered, and how they affect opportunities beyond loans. Come back, and we can unravel that too. For now, keep questioning, keep learning, and keep positioning yourself within these systems with insight and calm. Thanks for spending this time thinking with me today.